Thank you, and good morning, everybody. Thank you for joining our webinar today. All right, so just a little bit of a disclaimer here is that you shouldn't solely rely on the information per se in this presentation, as the laws constantly change and the list that we have included in there and the charts are ever evolving. So we're using this as a guide for you to refer to, but if you are going to comply in each of the states, you really should take an independent look at the tax laws for each state. My name is Tony Sudajewski, and I'm going to be joined by my colleague Kyle this morning to go over this presentation. Unfortunately, we're not going to be able to take questions throughout the presentation, but I do have my email address listed here as well as Kyle. And after the presentation, if you do have any specific questions, we'd be happy to get back to you. We're just not going to have the time to address questions throughout the presentation. So today's agenda is we're going to speak obviously about the Wayfair decision, but the broad categories we're going to talk about today is just about sales tax collection nexus in general, the progression of it. We'll talk a little bit about the Wayfair decision, how this will affect what's called marketplace facilitators like Amazon and eBay. Kyle will talk about use tax notice and reporting requirements that states have passed legislation in 2017 requiring certain reporting requirements for sellers. We're going to talk a little bit about the Streamlined sales tax program, which many of you may not be aware of, that might be advantageous for you to take advantage of in certain situations. But we're also going to talk a bit about how Wayfair might impact your financial statements. We're also going to talk a little bit about what's going on in the U.S. Congress regarding the Wayfair decision, and probably most important at the end, we're going to suggest some recommended action steps to deal with this new court case. So I think this quote that I found from some reading of mine is pretty apropos with respect to this decision. All businesses will feel the full weight of the court's decision. And I believe that all businesses that sell remotely will be affected by the Wayfair decision. The other quote I found interesting was, what will the states do with all this newfound money? The Wayfair decision is, as we'll discuss, is requiring remote sellers to collect sales tax on their sales into states where they may not have otherwise had to collect that tax. On the other hand, the consumer who purchased the products or services presumably would have had to pay a use tax. Unfortunately, not every consumer follows that law and has paid the use tax. So presumably there's billions of dollars out there of uncollected tax. States will now presumably find more money coming into the state, and will that affect other tax types? Will the state reduce their income tax rates, reduce their sales tax rates, and so forth? So that's just something that's sort of interesting as a result of this decision. We'll just have to see what states do in that regard. Okay. So just to step back a little bit, we just want to talk about a little bit about sales tax collection nexus in general. There has always been some confusion of when a remote seller is required to collect sales tax in the state. And the whole progression of sales tax collection nexus actually started, and we're not going to go through each of these, but it started in the 1960s under a U.S. Supreme Court case called Scripto. And in this case, a taxpayer or a company used independent contractors to solicit their products in the state of Florida. And Florida tried to impose a sales tax collection obligation on that company who was using those independent contractors to solicit. The long and short of it is the U.S. Supreme Court back then said, due to that physical presence, the company was in fact required to collect sales tax on its sales into Florida, even though the individuals who were soliciting there were not the employees of the company. So that is one of the first indications where we heard from the U.S. Supreme Court that said that a physical presence is required in order to in order for a state to have the legal authority to require a remote seller to collect the tax. In 1967, another significant U.S. Supreme Court case came about, National Bellis Hess, and this was a case whereby the company sent in catalogs into North Dakota, or I'm sorry, it was in Illinois, I believe, sent catalogs into a state, and the state basically said that that was enough to create the nexus. Sending catalogs, generating sales from the state was enough to require the remote seller to collect the tax. Again, the U.S. Supreme Court held that you need more than just simply selling catalogs into the state or generating sales. Back in 1967, the court felt that you need a substantial nexus, which would mean a physical presence requirement into the state. Many years later, actually 25 years later, that case was again challenged under the Quill case, whereby Quill was selling into North Dakota and shipping its products. North Dakota was claiming that Quill had an economic presence. It was generating sufficient sales within its state. It didn't have a physical presence in the state. It shipped everything common carrier into the state. And again, the U.S. Supreme Court held that back in 1992, that a physical presence is required in order to have nexus. So since 1992, we've been operating under the rule, the U.S. Supreme Court rule, that in order for a state to require a remote seller to collect tax, they'd have to have some kind of physical presence. Then the internet came about in the 1990s and 2000, and that basically changed everything. And that's where states were finding that selling products into their customer were more than through just merely catalog, but anybody could get onto the internet and collect and order products. So a lot of revenue was being generated out of those states, but unfortunately those individuals weren't remitting the use tax. So the states began to challenge that, finding that they were losing millions and hundreds of millions of dollars in taxes. So the internet really changed the landscape of the nexus requirement. And I guess that's all that needs to be said there. And I would say Amazon was the leader in actually changing the whole sales tax nexus. It went from simply selling books to becoming this mammoth e-commerce company. And as you can see, there was many different ways the state was challenging physical presence through a click-through nexus or by fulfillment by Amazon nexus, whereby you had an inventory stored in an Amazon warehouse, and Amazon was basically selling that inventory on your behalf. And then in the 2000s, states started to become very aggressive and actually put statutes on their books to require companies to collect sales tax if they had only economic nexus, although they understood that was unconstitutional. So the progression of sales tax has really come a long way from a physical presence standard to an economic nexus standard, and I believe that whole economic nexus standard was really brought about by the whole e-commerce and Amazon sort of model of selling products. Because of the economic nexus statutes that the states had on their books wasn't constitutional in the U.S. Supreme Court, states could not really enforce that. So Colorado back in 2010 understood that, and they imposed what's called the use tax notification and reporting obligations. And what basically that was a requirement that if you're selling into the state, and Kyle will talk a little bit more about this, if you're selling into Colorado, they understood that they could not impose a sales tax on a remote seller because they didn't have physical presence there, but they believed that they could impose these notification reporting obligations on a remote seller to notify the customer that use tax was due and notify and report to the state those customers that you had sales to. That was challenged by Direct Marketing Association, and it went through the court system, and it was basically held that it was not unconstitutional to require this notification and reporting obligation. It actually went to the U.S. Supreme Court that ruled on a procedural issue. And in that procedural issue, Justice Kennedy, when he was voicing his opinion in the written opinion, essentially said that this is constitutional, but the court should probably revisit whether or not the physical presence test is still good under the Constitution, under Quill, and it should be re-examined in light of modern economic realities, meaning the internet sales. So because of that comment, many states latched onto that and thought Kennedy was basically inviting a challenge to the U.S. Supreme Court of the Quill case. So they began passing economic nexus statutes, and there was a proliferation of those. Many states were passing these statutes under the notion that the U.S. Supreme Court would eventually hear this and that their statutes could go into effect. South Dakota was one of the first states that did that, and they actually were able to get their statute to the U.S. Supreme Court under the Wayfair case, which is actually three companies which were under attack by South Dakota: Wayfair, Newegg, and Overstock. They were the three companies that South Dakota was challenging. We refer this to as the Wayfair case, but there was actually three companies. So in essence, what happened is the U.S. Supreme Court agreed that economic nexus should be the standard for, in today's world, of requiring remote sellers to collect tax. So that brings us to the National Bellis and Quill was overruled on June 21st by the U.S. Supreme Court. Essentially, they said that the physical presence requirement is now eliminated for sales tax collection nexus. And interestingly, they made some comments in their written opinion indicating that the physical presence standard in today's world is really unsound and incorrect. It's unworkable. It's unfair and unjust. It actually creates marketplace distortions favoring remote sellers, meaning that remote sellers don't have to collect the tax, but those that are physically present in the state would have to correct the tax. And interestingly, they said it creates a tax shelter, meaning that this not having physical presence means that the remote seller doesn't have to collect the sales tax, and understanding that consumers aren't paying the use tax. The U.S. Supreme Court did not, however, rule on the constitutionality of the tax as a whole. It did not formally validate the South Dakota law. It simply held that the physical presence isn't the sole standard to utilize anymore if a remote seller has substantial physical presence in the state. So what is substantial? Well, it could be physical, it could be a physical presence in the state, as well as economic and virtual contacts. And we're going to talk a little bit more about what states are considering as substantial economic and virtual contacts. The South Dakota law had basically three prongs that the Supreme Court, it was a 5-4 decision by the Supreme Court, so it was a very close decision. But they recognize that South Dakota economic nexus statute, they believe that it would pass constitutional muster because it had three items in it. One, it had the in-state delivery of more than $100,000 of goods or services, or 200 or more separate transactions into the state. The U.S. Supreme Court believed that selling more than $100,000 or having more than 200 transactions in the state is substantial enough, as a substantial nexus to allow a state to require a remote seller to collect tax. There was no retroactive obligation to collect the tax, and they were also members of the Streamlined Sales and Use Tax Agreement. We just want to make a note that there are 5 states that do not impose the sales tax: Alaska, Delaware, Montana, New Hampshire, and Oregon. However, that these vendors will be required to collect sales tax with respect to sales that they may have into other states, even though they don't have to collect sales tax or never had to before in their own state. So how certain is this Wayfair decision? Well, it was remanded back to South Dakota to review whether or not there's any other constitutional issues that should be raised. Right now, it's tied up in the court systems in South Dakota. There's actually a statutory injunction in South Dakota that South Dakota can't impose their law until the injunction is lifted. However, today there's actually a special legislation to pass a bill in South Dakota to essentially lift that injunction so that South Dakota will have the ability to enforce its law. Will any determination be appealed to the U.S. Supreme Court? It's very doubtful. It's very doubtful if there's any other constitutional issues that the taxpayers will raise in South Dakota that the U.S. Supreme Court will need to hear. Going forward, will any other business argue constitutionality on the Wayfair decision? It's possible a business might argue that the sales and transaction threshold is too low, it's not substantial in a state, or they might raise other constitutional issues. But as of now, the way we see it, the Wayfair decision is the law of the land, and companies will have to comply with it. Just want to address a few misconceptions of the law. One of the misconceptions that you may be reading about is that it's all based upon internet retailers that have sold into the state, and that's who Wayfair is, Overstock, and Amazon. However, the decision does not only apply to internet retailers of products like Wayfair or Overstock or Amazon, but applies to anybody that's selling remotely into another state. The decision only applies to those that sell taxable products. It doesn't apply to those that sell for resale. We'll talk about that later, but again, whether or not you sell a taxable product into a state does not mean you will not have a filing obligation in that state and have to register for sales tax. The decision doesn't apply to those that sell services. Most states don't tax services, but there are states that do tax services. So if you do sell services into a state remotely, you're performing the service in Connecticut, for example, but it's being received remotely in another state, and that state taxes the services, you could be subject to tax. The decision only applies to U.S.-based businesses. Again, that's not true. If a foreign company is selling into the U.S., that will apply to them. I no longer have to worry about the use tax notice and reporting requirements that states have instituted that Kyle will talk about. And again, that's not true. If you do not have to collect the tax under their economic nexus statute, or the state doesn't impose an economic nexus statute, you may still have those notification requirements. The decision does not impact my financial statements. Again, that's not true. If you do not comply with all the state laws, it could have an effect on your financial statements. You may have to set up a reserve or a disclosure. And this one may or may not be a misconception. I'm ready to comply with the Wayfair decision and notice and reporting requirements. You may believe you're ready to comply, but what you don't know basically may hurt you, and you may not be realized what you need to do to comply with this decision and the reporting requirements. So the sellers that are impacted by this are all remote sellers in every industry type. No industry type is exempt. So just assume you have $100,000 of sales sold into each state. It means a company with only $5 million of sales could be subject to these remote sales tax compliance obligations. As we said, it applies to e-retailers and internet sellers. It also applies to sellers that are using marketplace facilitators. So if you have inventory stored in an Amazon warehouse, that will apply to you. or if the marketplace facilitator like Amazon is collecting a tax or needs to collect a tax for you, that will also apply to you. It could also apply to any seller of tangible personal property. So again, it could apply to manufacturers, distributors, and retailers that sell property into the state. With respect to tangible personal property, a presumption is made that all receipts from the sale of tangible personal property are taxable until the seller proves otherwise through obtaining a resale certificate, exemption certificate, or direct pay permanent evidence, or the product is specifically exempt. Like, for example, certain states exempt food products. In other cases where a manufacturer sells into a state, the sale may be exempt because it's selling to a retailer who will resell it, but that manufacturer may very well have to register with the state, file sales tax returns, and obtain those resale certificates or exemption certificates from their customers. It could also apply to technology sellers, so those who sell software or software as a service, meaning software that's accessed remotely into a state, could be subject to tax now and have to collect a tax, whereas before this type of seller didn't have to because they didn't have a physical presence. So some states tax data processing services, also the sale of digital goods and sale of streaming subscriptions could be subject to sales tax collection. And again, the technology seller may not have had a physical presence in these states where they were selling this, now would have to presumably collect the tax if they meet certain thresholds and register with the states. It could also apply to service providers. So if you have a consultant or repair services, or you're providing information services, these types of services generally aren't taxable in many states, but in some cases they are. So again, if you're providing consulting services from Connecticut or repair services from Connecticut to a customer in another state, and that state taxes repair services or consulting services, then you may very well have to register in those states and collect the tax. An interesting twist on this is use tax liability owed. Generally, if you sell if you ship catalogs or marketing promotional materials or samples into a state, you may have to pay use tax on those catalogs that are being shipped into those states if you have Nexus in those states. In the past, you were sending catalogs into a state where you never had a physical presence, so you probably never had to worry about paying use tax on the catalogs that you were using in those states or marketing promotion materials. Now with this economic nexus, you may very well have nexus in those states, so now all of a sudden your catalogs and marketing promotional materials may now be subject to use tax in those states. And again, as I mentioned before, this is not limited to just U.S. businesses selling in the state, but also applies to foreign companies. So if you're affiliated with any foreign entities that are selling into the U.S., you want to make them aware of this Wayfair case. Again, even though they don't have a physical presence in the state, if they are selling into the state and meet certain thresholds, they would be required to register with the state and collect a sales tax, even if they're selling through the internet or shipping via common carrier, which could lead to other income tax concerns for that foreign company. So again, it doesn't apply just to U.S. businesses. It applies to anybody in the world that's selling into the U.S. So as you can see, this has a very widespread implication. The Wayfair case has a very widespread implication. So with that, I'm going to take a break and turn it over to Kyle, who's going to talk a little bit about what states are doing and what they believe substantial nexus is on the economic side of things to require a remote vendor to collect the tax.
All right, so here is a list of states with established and enforceable economic nexus provisions and effective dates, with the exception of the states that you can see with question marks, which are states that are currently pending. This table also shows each state's economic nexus sales threshold, but note that this table does not show economic nexus transaction thresholds, which talked about and which are often present in states. And as you can see, many of these states have taken kind of the safe route by adopting South Dakota's sales threshold of $100,000, but some of the states elected to adopt higher thresholds. For example, Massachusetts' threshold is $500,000.
I guess I just want to point out we do have some question marks next to some of them, and that's because there is some pending legislation. For example, in California and Texas have proposed a $500,000 limitation.
Yep.
But the law hasn't been enacted yet.
All right, so state elective economic nexus. So some states have actually have the option of elective collection or notice and reporting requirements. For example, Pennsylvania provides that a remote seller that has taxable retail sales of at least $10,000 in the prior 12 months must affirmatively elect to collect sales tax or comply with its notice and reporting requirements. So basically, failure to make that election is deemed an election to comply with the notice and reporting requirements. And failure to comply with these notice and reporting requirements could result in large penalties. For example, 20% of annual Pennsylvania sales. Washington also provides that remote sellers must either collect and remit sales taxes or comply with its notice and reporting requirements if its sales sourced to Washington are at least $10,000. And again, a remote seller could be subject to significant penalties if it does not collect and remit the tax and does not comply with the notice and reporting requirements. Failure to comply with these requirements could result in a penalty in excess of $45,000 each year, which, as you can imagine, that adds up pretty quickly. But for Washington, it is important to note that once a business exceeds the economic nexus threshold of $100,000 or 200 transactions, the business must register and collect Washington retail sales and use tax. So basically, there's no longer a choice after this threshold is met. All right, so here's a list of states that have an elective alternative that I was just talking about with their applicable sales thresholds. And again, I want to note that this table does not show transaction thresholds, which may be present in these states. So right now we've got Georgia, Oklahoma, Pennsylvania, Rhode Island, and Washington on this list. So effective dates. So here's a list of effective dates for economic nexus sales tax collection. And as you can see, there is a wide range of effective dates here. We've got dates preceding June 21st, 2018. We've got dates in July, September, October, November, and December of 2018. I've seen a lot of states with effective dates starting January 1st of this next year, 2019, and some states actually post the first day of next year. And some dates are actually pending the outcome of state litigation at the moment.
Yeah, we're essentially seeing most states adopting in October 1st, 2018 states. There's probably 15 states perhaps that are using that date. These other dates are sort of ad hoc dates for miscellaneous dates. But October 1st is probably the date to key in on.
All right, so pre-webinar effective dates. Are you compliant in these states? So I want to note that this is not an all-inclusive list, but here are just some examples of states with effective dates that precede this webinar. So you may want to ask yourself if you are in fact compliant in these states. So for example, Hawaii, Maine, and Vermont all have effective dates of July 1st, 2018. And Massachusetts, in fact, has an effective date October 1st, 2017. And Tony, I'm interested to see if this retroactive effective date in Massachusetts would hold up in court, but we'll have to keep an eye out for that court case if it ever comes up.
Hey, thanks, Kyle. So we just want to talk a little bit about the sales and transaction thresholds that Kyle mentioned. As I mentioned, the South Dakota case was the South Dakota law used $100,000 of sales and 200 transactions, and Wayfair essentially, the U.S. Supreme Court essentially blessed at that threshold was substantial enough. Personally, I don't believe $100,000 of sales into a state is really substantial, but that is sort of what we're under. The interesting thing is a lot of states are using the phrase total sales and not necessarily taxable sales. So you could have total sales over $100,000 in a state, and 0 of the sales are taxable because they're for resale or they're a sale of an exempt product or what have you. You would still be required to register with the state because you have met that economic nexus threshold if the state uses the total sales threshold versus the taxable sales threshold. And what we're seeing is most states are sort of gleaming on to the total sales. The other interesting thing to be aware of, it's not only a sales threshold, but it's also a transaction threshold. So the way the law is written in most states, it's either sales over a certain amount or transactions over a certain amount. So for example, if a state has a 200 transaction threshold, you could have 201 $1 transactions, and that would still require you to register in the state, even though your sales are less than $100,000. The interesting thing is when do you start to collect? Presumably, you would start to collect once you exceed the $100,000 threshold. You know, obviously, you couldn't go back for the prior years or prior months. So once you exceed that $100,000 threshold, but what you have to be careful of is what I call I'll call it the trailing nexus standard. Under the second bullet there for economic nexus, the sales and transaction thresholds are often based on the current year sales transactions or the prior year sales and transactions. So even though your current year sales or transactions may not be over the thresholds, $100,000 or $200, if last year's sales or transactions were over those thresholds, then you would be required to start collecting the tax immediately. For example, October 1st, 2018, even though you haven't met the $100,000 or transaction threshold. On the flip side is if, for example, if you exceed the threshold this year, but next year you don't exceed the threshold, it doesn't matter because you have to look back to the prior year. So it's either the current year's threshold is exceeded or you exceeded a threshold in the prior year. And that's what I mean by trailing nexus, is that even though you may not have technically economic nexus in the current year, it sort of trails from the prior year. So we just have to be careful about that. Just a little note on marketplace facilitators. Many of you or some of you may be using so-called marketplace facilitators like Amazon or eBay to sell your product. And the definition, it's important to understand the definition of a marketplace facilitator. It's meant generally a person that collects payments from a third party's customer and remits the payment to the seller in some fashion. States have actually enacted legislation that would require the marketplace facilitator to collect the tax if you do not have economic nexus. So for example, let's say you don't have economic nexus in Rhode Island, so you wouldn't be required to collect the tax on your sales into Rhode Island, but the marketplace facilitator has nexus in Rhode Island, then that marketplace facilitator that you're using to sell your products through the internet would be required to collect the tax on your behalf. So if you are using these marketplace facilitators, you may or may not be having to be required to collect the tax. So here's just sort of it's a listing of, not an exhaustive listing, but a listing of the states that have marketplace facilitator laws in place. So if you're selling through eBay or through Amazon and you're considered a marketplace vendor, then you just have to be aware of whether or not you have to collect the tax or whether the marketplace facilitator is collecting the tax on your behalf already. Talked a little bit about exemption certificate. Again, a presumption is made that all receipts from the sale of tangible personal property are considered to be taxable until the seller proves otherwise or the property is specifically exempt. I haven't seen any really discussion around whether or not a remote seller that has over $100,000 in non-taxable sales, and say all the sales are non-taxable, presumably the seller would have economic nexus and would have to register with the state and would have to file essentially 0 sales tax returns. But the more burdensome piece of it would be that remote seller would also have to collect exemption certificates. So a manufacturer that sells to a distributor in the state would have to collect resale exemption certificates, whereas before it may not have had to because it didn't have a physical presence nexus in the state. Or a seller who sells manufacturing equipment into a state may have to collect a manufacturing machinery exemption certificate and file 0 tax returns. I haven't seen the states back down or have discussed this burdensome requirement on remote sellers. There hasn't been really any discussion on that and whether or not the states will say if you're just a manufacturer selling to distributors, will sort of relieve you from the requirement to obtain the exemption certificates. So perhaps states will be addressing that once businesses speak out a little bit more about that burdensome requirement. But if you can imagine selling in all 50 states and having to get resale certificates and keeping them updated in all 50 states, that will be very burdensome for remote sellers, whereas now it's very limited to where they have a physical presence. So with that, I am going to turn it over to the notice and reporting requirements so that Kyle can discuss this additional layer of perhaps compliance.
All right, thanks, Tony. So prior to the Wayfair decision, states have enacted legislation requiring remote sellers who are not required to collect sales tax to notify their customers that use tax may be due and report a listing of those customers to state tax authorities. And generally, there's 4 types of notification or reporting that is required. So notices on the business's website that use taxes may be due. Notice the customer at the time of sale that use taxes may be due, for example, on the invoice. Annual and or quarterly reports to the customer, and annual reports to the taxing authority with information like customer names, addresses, and total amount of purchases. And as we mentioned before, penalties for non-compliance for each violation in this area can be significant. So here's a list of states that have enacted notice and reporting requirement legislation. So you may be asking, why are there so many states here, and what is the benefit of passing these laws? Well, these notice and reporting requirements were a really great option for states that were struggling to collect use taxes pre-Wayfair when they had the physical presence test in their way and no real way to track down taxpayers who were steering clear of paying those use taxes. And these laws, these types of laws, which were ruled constitutional in the DMA case that Tony just talked about earlier, allowed states to identify and go after taxpayers who weren't remitting use tax that should have been. And additionally, these laws are so incredibly overwhelming that many companies found it easier to just kind of bite the bullet and collect and remit the tax rather than complying with these burdensome notice and reporting requirements. So it was kind of a win-win for states to pass this legislation. So there are states where this could apply pre-Wayfair, as much of this legislation is effective pre-Wayfair. And there are states where this could apply post-Wayfair as well. For example, states that do not utilize an economic threshold, nexus threshold, but have notification or reporting requirements. Also states where a business has no physical presence and exceeds the notice and reporting sales threshold, but is below the economic nexus sales threshold. And also states that use the notice and reporting requirement as an elective alternative to collecting, which I talked about earlier. All right, so now I'm going to talk for a second on refers. Some states actually impose notice and reporting requirements on refers. So what is a refer? It's the person who contracts with or otherwise agrees with a seller to list or advertise for sale products by any means, including an internet website. And the distinction between marketplace facilitators, which Tony talked about earlier, and referrers is that referrers are not involved in actually collecting the payment for the sale of a seller's product and are not subject to sales tax collection requirements.
The Streamlined sales tax project, many of you may have heard of this, but this may now become a little bit more important to you as a result of this Wayfair decision. So Kyle is just going to briefly talk a little bit about it.
Yeah, sure. So this project was created by the National Governors Association and the National Conference of State Legislators all the way back in the fall of 1999 to basically try to simplify sales tax collection. This Streamlined sales tax agreement is the result of a cooperative effort of states and the business community to simplify and make more uniform the sales and use tax collection and administration by retailers and states. And this agreement minimizes costs and administrative burdens on retailers that collect sales tax, particularly retailers operating in multiple states. And the purpose of this agreement is to provide a roadmap for states who want to simplify and modernize sales and use tax administration in their states in order to substantially reduce the burden of tax compliance. This agreement focuses on improving sales and use tax administration systems for all sellers and for all types of commerce through all the following that I'll list here. State-level administration of sales and use tax collections, uniformity in the state and local tax bases, which is really nice, uniformity of major tax-based definitions, central electronic registration system for all member states, which I'll talk about on the next slide, simplification of state and local tax rates, uniform sourcing rules for all taxable transactions, simplified administration of exemptions, simplified tax returns, simplification of tax remittances, and protection of consumer privacy. So to date, 24 of the 45 states with a general sales and use tax have passed the conforming legislation to be a part of this group, and you can see the states listed here. It's important to note that not all of these states currently have economic nexus provisions, and you can register to collect and remit sales tax in all 24 Streamlined member states by completing one application through the SSTRS. And it's important to note that this is currently an all or nothing registration. As of right now, you can't pick and choose which states you want to register in. It's an all or nothing application basically, but there's no fee to register. Each state will send you the info related to its sales and use taxes, and you'll be responsible for filing returns with each Streamlined state. And I want to note here that the Streamlined Sales Tax Governing Board has contracts with certified service providers that can assist you with your sales and use tax responsibilities and provide other really great benefits, such as state-funded sales tax administration software. So some developments in this world right now. The Governing Board Executive Committee is meeting regularly to discuss the impact of Wayfair on all of its 24 member states. There's currently a proposal to allow sellers to not have to register in all 24 states, essentially breaking the SST group away from the all or nothing registration requirement. And there's currently a proposal to allow non-member states to participate in the central registration system, basically for a fee. All right, now I'm going to hand it back to Tony to talk about the financial statement impact.
Thanks, Kyle. So how does this impact your financial statements? Well, it generally doesn't, so long as you are fully complying with the notification requirements and the sales tax collection obligations you have, whether it's physical presence or the Wayfair decision. There's basically two statements that the auditors look at when determining whether or not you have to accrue a tax or sales tax. One is the SAC 450, and the other is 405. And 450 applies when there is uncertainty whether the entity will be subject to liability for uncollected sales use tax as a result of the Wayfair decision. If there's some kind of uncertainty, then the auditors will look at 450 to determine whether or not there's a reserve required or a liability that needs to be booked, or whether or not there may need to be disclosure on your financial statements. Again, it's as a result of not complying with your sales tax collection obligations and your notification requirements. Presumably, that would be from the effective dates. Most states aren't going, many states, or I would say none right now, are going back retroactively. So the earliest we see would be the July 1st, 2018 for those 3 or 4 states we mentioned before, where if you haven't complied since then, there may be some exposure. But most of the states are October 1st and forward. So any past non-compliance on economic nexus wouldn't have to be accrued or disclosed. But if there's physical presence nexus, then those liabilities might have to be accrued or disclosed if they're material. The other statement that the auditors will look at is ASC 405, and this is if it is certain that an entity will be subject to liability for uncollected sales tax as a result of the Wayfair decision, then liability is to be accrued. So if you are, to use the word, ignoring collecting the tax in the economic nexus states, that amount may have to be quantified, and since October 1st, for example, may have to be quantified, and interest and penalties may have to be quantified as well to determine what the materiality is, to determine whether or not a liability would have to be booked. So the implications of ASC 450 and 405 with respect to Wayfair is sort of ever developing. So you really should be discussing this with your auditors or your financial statement preparer to assure yourself that you have at least considered the Wayfair decision and the notice and reporting requirement non-compliance impact on your financial statements. So again, there could be a financial statement impact if you have historical physical presence where you haven't collected the tax or received exemption certificate. There could be historical Wayfair economic presence, since July 1st or going forward. There could be prospective physical and economic presence. So, for example, if we come into 2019, now you don't have just October, November, December, for example, for a year-end financial statement of noncompliance. You have those 3 months plus the entire year of 2019. So if this isn't addressed in some manner, this liability could potentially grow and become an issue for financial statements. Just a kind of a listing of some of the interested parties who've had their hand into this whole Wayfair decision. The first one is the Streamlined sales tax we talked about. They're the ones who started sort of latched onto this and try to make their law make their laws simpler among the different states that are members to kind of get Congress's attention. And also the United States Congress is also stepping into the action as well. In fact, there are 5 bills right now pending in the U.S. Congress. One just came out actually yesterday from Representative Bob Gibbs from Ohio, who proposed a bill entitled Protecting Businesses from the Burdensome Compliance Cost. And his bill includes barring states from having a start date earlier than January 1st, 2019 to give businesses some more breathing room to comply. And some other simplifications like allowing sales tax to be remitted to a single location where it would then be divvied up, using a uniform tax rate, things of that nature to make it as simple as possible for businesses to comply. And as you can see, there's some other bills there that are pro-Wayfair, meaning that, or undue quill, meaning that you know, these bills would put into law, not only a U.S. Supreme Court decision, but it would put into federal law that states would be allowed to require companies to collect sales tax if they have economic nexus. And then there's some bills in there that overrule Wayfair that believe that physical presence should still be the standard. So where are we going tomorrow with all this? As I mentioned, there are 4 or 5 bills that are out there that have federal sales tax collection legislation. Will the Supreme Court hear another case on this or an economic income tax nexus? We don't know. Will states be more aggressive with economic nexus for other tax types like gross receipts taxes and non-income tax basis? And now the states are feeling emboldened by the Supreme Court. Will they try to overrule Public Law 86-272, which provides income tax protection for certain companies? All right, so to wrap it up in the next few minutes, we just have some broad action steps to consider with respect to complying with Wayfair and Nexus in general. I think the first thing that a company needs to do, at least annually or maybe semi-annually, is really understand where their physical presence and economic nexus footprint is, gross sales into the state, and number of transactions into the state. So that's the first thing they would have, a company should do, is really understand where they have this nexus. When you're dealing with sales tax collection nexus, you also have to think about other tax types. You have to take a holistic approach. So you may have nexus for sales tax collection, and you may go full forward with registering for sales tax collection, but you have to be careful whether or not other tax types might apply, like gross receipts taxes or income taxes or minimum taxes. So before just going in and registering for sales tax collection, you want to understand if you're tripping yourself up for any other tax types. Probably the most difficult piece of the whole thing is taxability determinations of your products and services. Unfortunately, there are, other than in the streamlined sales tax states that Kyle talked about, where there are some consistent definitions and exemptions, but most states have their own definitions of what products are taxable and not taxable, what services are taxable and not taxable. So a product sold in Connecticut may not be taxable in California, or a service sold in Connecticut may not be taxable in another state. Once you figure that out, then you have to quantify it, and there's over 10,000 sales and use tax as jurisdictions. So not only do states impose sales taxes, but local jurisdictions also impose taxes as well. So you essentially would have to know exactly where you're shipping your product to and what tax rate should be imposed. Are you using a marketplace facilitator? Again, if you are selling through Amazon or eBay, you have to kind of speak with them to see if they're collecting the tax for you or how you're going to facilitate the collecting of tax if you have nexus in the state. You have to review your reporting and notification compliance. Have you been complying in that area? It's basically been since 2017, so maybe this is a good year to catch up on that. And again, if you're not complying, and if you are discovered for non-complying, there could be significant penalties for not complying. Once you've got your head around that, you kind of want to understand how you strategically should enter into a state. Should you enter just prospectively under the Wayfair notion that the states are going to be receiving hundreds and hundreds and hundreds and thousands of registrations, and hopefully you'll be going under the radar screen? Or should you voluntarily disclose and or enter into amnesty programs and try to shore up your tax obligations from the prior 3 years or 4 years? Then you're going to have to register with the tax authorities in these states in order to get an ID number and collect a tax. You also have to understand your 450 or 405 financial statement potential disclosures or liabilities. You have to discuss that with your auditors. And then going forward, prospective compliance is, do you have the internal resources? How is this going to interface with your invoicing system? How are you going to apply the right tax rate to the invoicing, to the invoice? Do you have software automation? Do you really want to outsource that? that whole function to someone else now. If you're going to do it internally, do you have internal controls? If you're selling on a resale basis or an exemption basis, are you going to be able to manage all those exemption certificates? Invoicing standards will have to be revisited. Whether you're selling products or services, you may have to separately state taxable from non-taxable products and services so that you apply the tax to the proper item. Drop shipments, if you're a drop shipper or you're using drop shippers, this could impact your sales tax liability, whether or not you would have to collect the tax or whether or not the drop shipper would have to collect the tax. So that gets impacted by this Wayfair decision. Use tax accrual should be less because the vendor should presumably be invoicing you for the tax, but if they're not, you still would have to pay use tax. If you're involved in a business acquisition, you want to do some due diligence to make sure that the target company is complying with its sales tax obligations under Wayfair or before Wayfair physical presence nexus. You want to mitigate your responsible person liability. This is a sort of a nasty statute that states have in their law that basically says that if the business is unable to pay the taxes that are due to them, they can go after a responsible person who's responsible to understand the sales and use tax liability. Because in effect, the state is requiring you, the remote seller, to collect the tax for them as a trustee. And if the tax isn't collected for them, they could go after the business or a responsible person. So a responsible person could be the owner of the business, a partner of the business, the CFO of the business, anybody that the state believes it can go after who has the ultimate responsibility for sales tax collection. You want to actively monitor your physical presence and economic nexus over the last year or so. Do you need to do new registrations? Are there opportunities to withdraw from the state? Understanding that there is this trailing nexus. So if you had nexus in a prior period, you still may have nexus going forward, even though you may no longer have a physical or economic presence there. So again, just something to think of. And then the filing frequency. Once you register, the state will generally tell you what period you need to file. Mostly it's on mostly for new taxpayers, it's a quarterly basis. If your sales are over a certain amount, the state will put you on a monthly basis. If they're under a certain amount, then you may actually go to an annual or semi-annual basis. So there are all kind of compliance obligations that someone has to monitor those due dates. So with that, that ends today's webinar. Again, we appreciate your time today. We're sorry we couldn't take questions, but as you see, there was a lot of information we wanted to cover. If you do have any questions or need assistance, please email either me or Kyle.